I'm going to play a soundbite in just a second that will help set up this discussion because back in October on your podcast, your firm's thought leadership series, Simplify Asset Management, you had on then private citizen Scott Bessent, who's now the Secretary of the Treasury. And he said a couple of things. I watched your discussion with him that made me perk up. And I think a lot of us should have been paying attention to that. And you can go see this on their website and on their YouTube channel. But let's roll the first soundbite. It's a quickie, but it's a doozy.
There's an old Soviet nuclear strategy called escalate to de-escalate. And fortunately, it was never, or so far hasn't been used. But I think with tariffs, you can escalate you can put tariffs on with the idea of getting rid of all the tariffs.
What did you think when he said that? Because I'm feeling like I'm collateral damage if this tariff situation becomes a trade war.
Well, I think this is one of these really important components in recognizing first that a trade war requires two parties, right? You cannot be at war with yourself in trade. And so part of what Scott is highlighting is that the environment that has been in existence and allowed to persist is one in which the United States has been the consumer to the globe. And I like to use the expression, we are familiar with the statement, all roads lead to Rome. Roads are bidirectional. The statement is equally valid to say all roads lead from Rome, but we don't say it that way because at the heart of every empire is a consumption center. And the US has basically been the consumption center that has allowed the rest of the world to avoid many of the hard challenges and choices that would have traditionally been associated with rebalancing of currencies. When Scott says that, I think he means exactly what he's saying. He's recognizing that in one form or another, the customer is always right. And while we may experience periods of deprivation and actual tremendous frustration around the tariffs, the simple reality is at the end of the day, other people need their jobs to sell to the United States. The ability to use these tariffs in a proactive way to effectively force all tariffs towards zero, which is another stated goal, is certainly something that we shouldn't dismiss out of hand. We've already seen some of our allies move in that direction. The choice to go to a trade war is always a choice. And this is where the real challenge of Donald Trump and his failure to connect with the rest of the world diplomatically comes in. The immediate reaction is he can't tell us what to do. We're going to show him. And that leads us all to be in a much poorer situation, even though many of his complaints are quite valid.
When we talk about the strategy with tariffs, you've pointed out, and I think history has pointed out, that there is a negotiation that takes place. And the disaster that I hear colleagues of mine who are still in linear media, the disaster they're predicting has not yet come up. In fact, we see people willing to meet the United States not even halfway, perhaps give in to some of what we're requesting. Are you expecting that?
I think ultimately that is the direction that this likely goes. Unfortunately, it's a question of does it go there sooner or later? Again, I understand why France reacts with horror and anger at the idea that the U.S. is going to use its economic and military might to negotiate more favorable terms that to France feel distinctly unfavorable to them. But the reality is that it is creating significant disruptions. And France, candidly, is not really the core of the issue. Almost everything should be considered in the context of the real target here is China.
I was going to talk about Barolo because with a 200% tariff on imported wines, I was trying to stock up and they'd sold out. But let's talk about China. We saw what just happened with Apple. And is it an overreaction then for people to be selling stock in companies that have a very strong history but have a real big tie to supply chains that are linked to China?
So I think the supply chains are much less the issue than the recognition that there is still a significant consumer business and presence for Apple in China. It is less than it has been. But the Chinese Communist Party has very clearly said at this point, one of the retaliatory measures we have is simply to take the assets of foreign multinationals. Shouldn't be a surprise. All is fair in love and war, and this is a form of war.
I want to talk to you about how those of us in the United States who have enjoyed literally 40 years of capitalism and global free enterprise, I've been a passive investor and it's done very well for me. but you sound the alarm. And you, in your most recent Substack, you talked about some of the outflows that we've been witnessing over the past couple of months. And you pulled up a chart, and I'm going to pull up a quote from the Substack turning page, and people can subscribe to this on your Substack. But you wrote, if the passive outflows begin from the level the blue line suggests, lost decades, and you all capped decades. This is what freaked me out. And a likely loss of capital markets as they exist today. As a kid, we hear about what happened in the 70s when things were kind of just stagnant and Polaroid was a great hit and then crashed. What are you saying to people here about those of us? I think one estimate's 50% of people are passive investors, but it seems as if you're calling for people to really get active in managing their portfolios. Help me understand the warning you're issuing in that statement.
Well, so first of all, it's to be very, very clear, it's far over 50% of the people by number, right? So the vast majority of American households that now have exposure to U.S. equities will at least have a partial or in many cases complete exposure via passive entities like a Vanguard Total Market Index or a target date fund in their 401k. The issue with passive investing is, first of all, it doesn't actually exist. So the academic definition of passive investing is somebody who only holds every security. There is no provision in the academic literature for you to get in or to get out. And as a result, as a participant in a 401k plan, I'm going to take the guess, Jonathan, and in a situation in which you are working and continuing to contribute to your 401k, you're not a passive investor. You're an active investor pursuing a very simple systematic strategy. Do you have a job? Yes. Do you contribute money? Yes. If so, then buy. That's it. That's the entirety of the algorithm that exists. To expect that a larger and larger fraction of the population is tied to that type of systematic algorithm and not to have it influence security prices is borderline absurd.
Well, part of the way it affects prices when you have just a few stocks, we talk about the Mag 7, controlling the performance of, say, the S&P 500. And then if you're in what Mr. Vogel would have said, the Vanguard Index 500 or the Fidelity Spartan 500, are you saying that I'm setting myself up for a real crisis because those stocks are now under pressure and then subsequently the index to which I've staked my future is going to fall?
Well, I think actually that there are a couple of things that are actually being missed in the link there. First of all, by participating in a passive strategy, you actually have facilitated the growth of those companies. The typical response from an active manager rationally to a company that becomes as large as an Apple or as large as a Microsoft is to recognize that the odds of them continuing to grow their profits at the pace, their revenues and profits at the pace that they historically have is vanishingly small. And in fact, we see this. Apple has largely gone X growth since about 2015. But when you are contributing your money in a passive framework, there's a really interesting component that occurs because as you put the next dollar in, you are rewarding with the marginal capital the stocks that have gone up. The frictional dynamics of you buying that money, of buying those positions, actually causes the largest shares, the largest companies to outperform. And this then creates a feedback loop in which their cost of capital is lower. They can offer their employees attractive stock options as compared to high salaries. That creates a continual and perpetual advantage. And not only that, we actually turn and we look at the companies. We say, oh, they must be the best companies ever. Therefore, I really shouldn't challenge anything that the management teams want to do because this is the future. And so you're actually ironically creating the conditions of concentration that you're concerned about. And the answer is yes, of course, as the portfolio becomes more and more concentrated, which is an inevitable byproduct of this process, you are changing the characteristic of the system in which you are investing. You're no longer investing in a diversified index.
So I grew up being told, that the strategy of passive investing, and I realize that you're pointing out it's not actually just passive investing, but the strategy of putting my investment and growing over time into the Vanguard Index 500 and others, and I am actively involved in others and stuff, but may not be the way to go in the future, if I'm hearing this correctly. But I think for those of us who are not nearly close to as skilled as you and other professional money managers, how do we correct our portfolio if we need to correct our allocations at this point?
Well, I think there's really only a few things to highlight there. And I make a distinct point of articulating this. First is recognize that you're participating in that system, and the growing share of people participating in that system is roughly akin to the game that you might have played at the county fair, where you try to shoot a water gun into an inflating balloon, right, into the clown's mouth to inflate the balloon. If you and your friends all decide to shoot at the same clown, the odds of your winning go up dramatically. And as more and more people invest passively into the same indices, you're actually creating the conditions of outperformance for those securities in the particular configuration that you're describing. So one of the real challenges is, of course, that an activity that we now know is broadly harmful to our population in its totality is still the optimal choice for the individual. And so there's very little for the individual to do. Now, the individual is exposed to dramatically more risk if the flows reverse, and they can reverse for any number of reasons. We saw an element of them reversing in 2022. If that type of reversal occurs, then you'll see those same stocks perform the worst, which is broadly what we saw in 2022 or in the fourth quarter of 2018, when we had periods of momentary outflows from these types of systems. But the simple answer is, for you as an individual investor, I'm actually suggesting it's not your job to try to figure out what else to do. I do think that there are missed opportunities in things like very attractive fixed income rates relative to what we have experienced historically, certainly relative to the level of absolute growth and inflation that we're experiencing. But the reality is, that's just my opinion. And very much like John Belushi in the movie Animal House, if I say, "Who's with me?" and the answer is no one, it really doesn't actually matter, right? I should be trying to engage in the Keynesian beauty contest and predict what everybody else is doing. And the simple reality is they're going to continue to invest passively.
That's a great movie, Animal House. I want to remind the more than 3,000 people who are watching us on X that you can ask questions, or you can drop your question for Michael into the stream, and we will be happy to ask him and share your question. I want to bring up, you just brought up inflation. When you interviewed Besant, he said that Donald Trump's policies were not inflationary. In fact, he said that the strategy was somewhat disinflation and deflationary. I want to talk about that, but I also want to play something that jumped out at me, especially for people who are probably a little bit younger than you and me, the generation that is caught in a bind because asset prices are out of control. And here is what Besant said at the beginning of your discussion with him in October.
I live down in South Carolina, and the largest subprime lender is my neighbor. So I have good visibility into what is happening to the bottom quintile, and up to the bottom 50th percentile. And it's pretty clear in America today: either you own assets or you don't. Yeah. Or you have parents who can help you own assets, and it's a real problem. But to the point that what his company is seeing, it's lower end borrowers, but it's also young people who are now moving up toward record defaults on credit cards, on autos, and then the whole student loan morass.
So, Michael, I got to ask you, are we going to see asset deflation in order to help the people who've been left out rise?
I think it's very challenging to accept that that's going to be the underlying case. First, I just want to address a couple of points. So first, what Scott is referring to in terms of inflation is the fact that, unlike the fiscal stimulus that occurred in 2020 and 2021, which provided a ton more income for people to buy stuff in the absence of an increase in production, in other words, demand went up relative to supply, that causes an outward shift in prices and the inflation that we've broadly experienced. As long as the inward shift in supply is not necessarily met by an increase in incomes, i.e. fiscal stimulus, or by a necessary contraction in supply, if the US were to decide that it wanted to begin producing more, the rest of the world were to respond in a non-retaliatory manner, that you would likely actually see falling prices. And I think I agree with Scott. I think there is some friction around that. I think it's really important for people to understand that the CPI basket, which is what we calculate the headline inflation number off of, that is a fixed basket for a period of a year. And so if car prices go up, the CPI will not reflect the fact that people buy fewer cars. And so it will almost certainly see an increase in the CPI associated with the higher costs and higher prices associated with the tariffs. However, if we look at other metrics, things like PCE, et cetera, which is the official metric, that actually does incorporate the ability for people to switch. And a lot of people get upset about that. They treat it as hedonic replacement, et cetera. That's just a simple reality. I go to the grocery store, and if I see that chicken is on sale relative to beef, I may call my wife up and say, hey, no steaks for dinner. We're going to have chicken breasts, right? That's not bizarre behavior, but it's not well captured in things like the CPI. It is captured in things like the PCE. So among other things, we should see a bit of a divergence. The second thing that I would hit with Scott's observation is that the real question becomes down to incomes. And so if we do decide that we are going to replace foreign production with domestic production, we will need additional workers to fill those roles. Those are likely to be younger people, and they can benefit from that framework. Whether that happens or not is very much up in the air.
We're getting quite a few questions here, and I just want to let our second block guests know I need to take some of these questions because they're populating very quickly. And the first for you, Michael, is what is the average long-term investor to do when the Vanguard ETF is so distorted?
Unfortunately, I think this is one of the challenging pieces of advice. So one, always remember that distorted is in the eye of the beholder. It can be even more distorted next year. So I want to, emphasize the immediacy of anything that I'm referring to, other than, of course, futures being down 4%, is not something that you should go out and change your portfolio today. The second thing, though, to recognize is that anytime you hear somebody saying what is priced into markets, there's effectively a new dominant piece of information about forward returns that exists in financial markets, which is who's going to buy what tomorrow. An increasing fraction of that is explained by passive flows. And so we know more and more that as long as people maintain employment, as long as they are contributing to their 401ks and participating in things like target date funds, the odds are very, very high that they are going to buy more Apple and Microsoft and NVIDIA than they are going to worry about Delta Airlines. The last thing I would just emphasize for people is those same programs, those same target date funds or balanced funds, et cetera, will not consider the relative merits of equities relative to bonds or other forms of fixed income. Credit comes to mind as an attractiveness measure. You may have an active financial manager, a registered investment advisor that does take that approach, but the vast majority of model portfolios and systematically rebalanced portfolios like target date funds don't even have an entry point for you to say what is the relative coupon of bonds relative to equities. And this is one of the reasons why going into the interest rate hikes in 2020 and 2020 or 2021 and 2022, a lot of people made the argument that value was going to outperform, that suddenly momentum was going to give way, that the large cap, high multiple companies were going to fall relative to the cheap companies. And the simple answer is there's no mechanism for that because the systems that we're using don't have the capacity to make those adjustments. There's nobody at Vanguard who suddenly says, hey, interest rates are higher, therefore you should buy more bonds. Or there's nobody at Vanguard who says, gosh, interest rates are a lot higher, therefore the forward discounted value of cash flows associated with Apple Computer is lower, and I should pay less for that relative to a low multiple auto parts company. The capacity to do that simply doesn't exist. And so you've got to be really careful in the information that you're receiving. And the one piece of advice I always try to remind people is you should invest for what you need, not what your neighbor wants. Right. And so if you can look at fixed income markets today and you can say, gosh, I'm well served by buying investment grade debt in the 4+% range or the 5% range. I'm well served by buying money market funds in the 4+% range, or I'm well served by buying municipal bonds that are offering attractive tax adjusted yields for me.
Right.
Consider doing that. You don't need to have the equity exposure.
So let's bring up the next two questions. From this one, money goes home, foreign savings in the USA, assets bringing it back. What are flows doing, and is he concerned? I do think you're concerned about flows, but we'll get that answer. And then the question after that, if we can pull that up, and I'm going to have you answer these two. It's hard to bring down asset prices for millennials as boomers enter the final stage of their lives. Would you agree with that? You and I are both Gen X, but what do you think of those two questions?
Well, I'm actually a millennial, maybe even a Gen Z, but only at heart. So there's a bunch of questions that were hit there. First, on the boomers, remember the boomers are ultimately going to have to sell. The great irony of Powell hiking rates at the end of the boomers' lifetime is in many ways he's actually forestalled them having to sell by raising the income associated with their existing fixed income assets. That's created a dramatic increase in income for the older population that is contributing to the reason why every cruise ship is sold out and why everyone's taking their grandchildren on vacations or buying homes for their children, because suddenly they're spending interest instead of principal. And that's much easier to do. I just try to always highlight for people that the math behind the wealth effect is that you typically will spend around 2% of the incremental value of your wealth gains. You will spend somewhere in the neighborhood of 70% of your incremental interest income gains, because you are not paying down, you're not paying out of your principal. Mm-hmm. People are much more comfortable paying that. As a result, the Fed has actually in many ways engaged in fiscal stimulus itself. And one of the components that, again, I think Scott is somewhat obliquely referring to is if the Fed cuts interest rates, many older Americans are actually going to face reduced income on their fixed income and cash portfolios just when they started to get used to it. And so it's not at all clear that it's going to be as stimulative as people think. The second question,
money goes home. Money goes home, foreigners' savings and USA assets. How do we get it back? What are the flows telling you?
So this is one of the key issues, and I alluded to this earlier. If you look around the rest of the world and you look at retirement programs around the rest of the world, they have this same Vanguard infestation that basically says you should just buy the market. And so in the United States, we bias ourselves, as most countries do, in a home country bias. That means on average, for a 25-year-old who's entering a retirement system in the United States, somewhere around 55 to 60 cents of every retirement dollar that they save is going into U.S. equities. That same number, if you live in the UK, is only about 15 cents. And so it's entirely plausible that countries like the United Kingdom or countries in Europe or countries in Asia, when faced with the need to invest in their countries, spend more money on defense, spend more money on infrastructure, all the things that we're asking them to do, say, hey, well, wait a second here, then we should actually make sure we hold on to more of the retirement dollars that are being invested by our young people. One mechanism that would then play out is that money would start to be shifted home with adverse consequences for valuations in the United States. And ironically, that might actually hit this concept of American exceptionalism. We can't know that this is going to happen in advance. It hasn't actually begun to happen in terms of a policy component, but we have seen a remarkable move of money moving from the United States towards Europe and Asia. This has contributed to the somewhat puzzling dynamics of a sell-off in risk assets while the US dollar weakened. That's an unusual combination in history, and it really is a very direct reflection of the fact that some of that money is going home. If more and more of that money goes home, if that money starts to go home in a formulaic, systematic way again, where the government effectively of the UK decrees, we want 55 cents of every retirement dollar in the UK to go to UK equities, then you will have meaningfully changed the character of flows, and you have to take that into consideration.